Hello, everyone. Welcome to our midday update for Monday, January 30th of 2017. This is George Papazov from Trade Pro Academy. I'm the owner here and head trader, and I want to remind you that tonight's presentation is for educational purposes. It's not investment advice or solicitation to buy or sell any securities and or recommendations. Trading in the financial markets is at your own risk, liability, and also profit potential. It's your risk, but it's also your profit. We're not responsible for any liabilities arising as a result of your market involvement or individual trade activities. All right, lawyers are happy. Let's make ourselves happy now. I want to talk to you about what's happened so far in today's equity market and why there's some worry and fear that's come back into it. First, I want to take you through to something very important. The VIX on Friday closed really close to an all-time low. It was so low that you almost had to buy calls on this VIX, and some people did in the Trade Pro room. Congrats to them. I did not. I puked the VIX call spread on this downside, and I just thought it was going to burn out some time. However, we made some good trades, not better. Every trade's a good trade that you could justify the risk on. And I want to walk you through that. Let me just hide this. This is our live trading floor here that we did. All these trades, by the way, are done on a live basis. I'll show you guys that. We have a few trading rooms here. And there you go. We show all of our trades as we do it. So it's not like we do these trades and then afterwards say, hey, look, here's what we did. We do it live. If we take a trade and we lose, who cares? We keep moving forward. There's a lot of learning opportunities in losing trades and in winning trades. You can do better in losing trades, and you could definitely do better in winning trades as well. So we share everything with you. This is a subscription-based service. If you join, it's $79 a month. In addition to this, you get a ton of education. You got education on futures, on options courses. You could also do a weekly income strategy that you could learn about and utilize. There's enough education and development material to trade profitably on your own basis, on your own schedule, and to create the type of life that you desire. And we just urge you to come out and check it out. There's a 14-day free trial if you visit us at tradeproacademy.com. All right, and you also get access 14 days to this live trading floor and all of our trade ideas and live analysis. Now I want to talk about the VIX. The VIX was so low that it was almost pricing in no likelihood of any type of fear event taking place. And that's exactly and precisely when we get a pop in volatility and something comes out. All right, since the Trump election, the market has rallied and ripped higher and higher. You want to take a measuring stick off this. If you just take the opening values to that high, we had about a 7% increase in stock prices on Trump's election. And then when he was sworn in and voted into office, we had a breakout to new highs of 2,300. A few days ago, I told you guys that this rally was not it didn't happen on good volume. And let me show you what I mean. We rallied to new highs, but there wasn't a lot of volume. There wasn't an exceptional amount of volume like here or even here. And what that indicates is that it's not retail buying into this. It's not a new up move by bulls or by people looking to buy into a trend. It's more of a stop loss by people who are shorting it. So what happened was the shorts got squeezed. 2 days later, literally right back in their range. What happened today that created this volatility? There's a number of things that you need to know about. Number one was the end of month rebalance. What the mutual funds do at the end of a month, they sell equities and buy bonds. Why? When equities are strong, they have to sell them and purchase bonds to rebalance their 60-40 asset mix. Okay, they promised investors 60% exposure to equity, 40% to bonds. When the market rallies, it ends up being more like 65% and 35%. So they have to sell 5% of their equities and buy the bonds. This end of month rebalance very rarely fails because this is a lot of institutional money. On Sunday's webinar, which is also a member feature at 8 p.m. Eastern, we talked about two things. One is the S&P 500 trade is getting a little carried away. There's too many longs, and all the shorts that we're shorting are starting to cut their position and started to get long. So when there's a lot of buyers and the shorts throw in the towel and start buying as well, what you have is the makings of a short squeeze. Or a long squeeze, rather. I apologize, but that's a long squeeze because everyone's on board. And if they're all buyers and they've already bought, now they become sellers, and on the way down, they puke. And they get out as their stop losses are hit. That was the dynamic. This was predictable. In yesterday's webinar, 8 p.m., I told everyone, all of our subscribers, start selling equities, start selling oil, and start buying gold. And that's what we've been doing on our accounts as well. All right, that's the VIX. The one indication for us at new highs that got us a little worried, that kind of told us a little bit, forecasted to be some weakness, was this. Russell did not hit a new high. Despite all other indices rallying and ripping new highs, Dow above 20K, all right, NASDAQ above 5650, Russell just wasn't having it. The small cap stocks were not leading. They were not contributing to this rally. This is usually indicative of a potential reversal in the market, or at the very least coming back to support and forming more consolidation. Remember, 70% of the time the market consolidates, 30% of the time it moves. These are the dynamics and the statistics behind the market you've got to be aware of. So you got to position yourself for that style of trading. That means 70% of the time you got to be patient or taking quick profits in a range. 30% of the time you could try a breakout, but that happens by playing the bottom of the range first. Today, that's what we're looking for in our trading. We look for a bottom, and we picked it really nice. We made some good money on it in front of our subscribers. In terms of S&P 500, I think we find support here. I don't think we just go through and smash this low. I think we might consolidate a few days and see if the bears have another shot to press us through. 63 to 64 is a level you have to plot on your chart on the index. Watch for that. All right, let's have a look at some other stuff. Let's have a look at oil. Oil below 53 got very bearish. Right now it's trading 52.70, and we're forming a bit of a triangle. But I think we break through some of these supports at 52, and we take this thing to 51. That's going to be our initial stop on oil. All right, 51 primarily, and then 50. And heck, I wouldn't be hard-pressed to see this thing down 47 to 48. Okay, another dynamic that put some risk-off sentiment or downward pressure on risk assets was the fact that Trump signed some immigration policies last Friday, and there was a bad reaction to them at airports. That caused some fear in the market. Another thing was Trump signed legislation this morning that say if you want to implement one policy, you've got to remove two. He called it one in, two out. And he talked about this in the campaign trail and before he was elected, that this is what he wanted to do. He said there's way too much legislation. If you want to introduce one policy, you got to take two out of existence in an effort to reduce legislation and administrative costs. It's not a terrible idea. But what starts to happen is all these decisions he's making by the flick of a pen and not really giving the market enough time to price it in starts to form a weight on the market. And what kind of weight is that? Imagine being the Swiss National Bank owning multiple billions of dollars of U.S. equity. Imagine being pension funds, institutions, mutual funds that hold equities. One shot is not a problem. Two shots, you start to get worried. Third shots, you say, hey, you know what? This guy with a flick of a pen signs legislation and policies that the market isn't expecting, which means you're not giving us time to price it in. Let the market know. Let it know that you're going to price it in. What ends up happening is traditionally the U.S. has been a place that's been forward-looking. Their analysis was logical for the most part, forward-looking. And if there's one thing it was indeed is that it gave the market time. It was market. It took it into effect what the market would do and how it would perceive it. Trump doesn't seem to care about that. And the market's getting spooked because they're saying, what is my overnight risk? What is my real risk exposure? And I think risk right now is underpriced. Everyone thinks there's no risk. However, we're at all-time highs, and it's every time we hit a new high, it gets that much harder and harder to go higher because you're getting less and less buyers to get on board the trade. Right? That's the dynamic. So in fact, the risk is to the downside. It's harder to go up in a bullish market like this. All right, the next high takes a lot more energy than the previous high. You got a lot of people piled on the long side. The shorts give up, and you get the dynamic to start pressing some lows. Okay, I pity the person that bought 2,300, but I'll tell you what, there's people that bought it. There's multiple people that bought it. There are people who bought into this rally at 2299.8, and there's people that bought it above as well. What was the high? 2303.8. That's the all-time high. Somebody must have bought it if it traded there. So everyone that was late to the game and chasing this rally is now stopped. Shorts have given up. Buyers are puking. We got more downside. Be very careful. I think oil, as long as it stays below these 53s, sell the thing. I missed a chance to sell these 52.80s. Kicking myself for it. But if we get 52.90 to 53.10, I'm going to sell it again and again and again. U.S. dollar also a little weak today. Gold, not as strong as it should be. Okay, the big money is getting scared here. They're rotating out of risk and looking for some safety. Bonds are trying to get a bit of a bid going. Gold's off a little bit, these 1180 lows, but be careful for gold. Volume is descending on this rally. There's signs of trouble here, and nobody's willing to acknowledge them. Okay, well, I'm the market whisperer, and I'm telling you, I'm sounding the alarm bells. I sounded them on Sunday, last night at 8 p.m., and I'll remind you that's still my prognosis. Here's the issue that I was having. Markets were ripping to new highs without market breadth continuing in that direction. We were overbought on market breadth, or the percentage of stocks above the 50-day moving average. They started to curl below. We broke this 50 support. Down we go. Sell stops are coming. 100 days in danger of taking out that 50 as well. And that's going to trigger massive selling. Okay, when I say massive, don't get me wrong. I'm not this bearish guy that always says we're going to drop 40% in the market just to get your attention. I'm not that guy. In fact, we probably won't drop 40%. Federal Reserve will step in and suppress the downside. That's what they've done since 2009. All right, you have to understand the market since 2009 have not rallied on a good economy. It's not like the economy's improved drastically. Okay, it hasn't been the economy. It's been the Fed. It's been free money being printed. It's been low-cost borrowing. It's been companies doing buybacks of their own shares. This thing's propped up on cheap money. It's not like we found a miraculous fix in 2009. We just kicked the can down the road by borrowing and printing more money. That's why the Fed's got $4.5 trillion balance sheet they're looking to unwind at some point. But I digress. More of that in some of the subscription-based webinars and what to do with that information. But as you can see here, market breadth is starting to falter. And you know that means more downside is coming. You just feel it. You know it. All right, on gold, if you're looking to get long gold, 1190 was your entry. We tried it, got stopped out with a 10-cent loss on the futures, which is $100. Not a big deal. Okay, actually not 10 cent, $1. $1 stop, that's $100. In the futures, one futures contract for gold's $100 per dollar, 1,000 per 10. All right, downside 1190 support was really logical. We had talked about why. A lot of volume profile ledges at the top here on Friday and on Thursday. You knew there was going to be bids to come in and soak up the selling. That's what we're looking for along. We missed it. Happened overnight. Gold trading happens in the London Metals Exchange for the most part. Okay, do you guys have any questions so far or comments? Just so I could address them before we carry on. I'm just looking here at our Trade Pro subscribers, see what they're saying and what they're not saying. Quiet group today. You guys are quiet. That's unusual of you. All right, let's look at some futures, and then we'll talk about some trades for the day. I'll show you guys what we've been trading in the trading for the live virtual trading room this morning. We knew right off the hop it was going to open bearish. Every pop was to be sold into. We rode the short here. All right, and then we started to buy the dip. We ended up buying this dip at 64.75. I literally told guys we're going to get short squeezed. This is too much selling too quickly. We're closing in the European session at 11:30. Be careful. When we're up here, I was saying, hey, you know what? We might break the slow, but just be careful. Get ready for a short squeeze because it's coming, and we made money on that short squeeze. All right, we have about 5,000 contracts short at 75.25. Okay, on the downside, it got really fast here. About 5,000 contracts that got short on a net basis. So net short, which means aggressive selling. That's going to be a natural resistance on the way up. Watch these 75s. We got about another 4,000 contracts at 77.5, which paints a nice resistance for you right here on the equity market. If you want to sell it as a swing trader, sell it up here. As a day trader, don't wait that long. You might reverse off these VWAPs. Wait to blow the first one out, grab this value area low, grab this high of the previous retrace, and just hammer the bid. Just let them have it. You're going to get some more downside. I would not be buying this dip for the long term saying new highs are coming up. I'd be very cautious. I think the smart money has converted to selling rallies. And you need to be with that smart money. Don't buy it here saying, hey, it was just 2,300 2 days ago. It's going to get back up there. That's not a reason for a rally. Who cares where it was? Enron used to be a couple $100. Where is it now? It's laying 6 feet deep underneath the sand. It's done. It's a dead stock. So be careful. Not necessarily the S&P and 500 will do that, but careful benchmarking yourself to level it was and calling it cheap. Of course, it was cheap on Friday because we didn't have Trump with all these policies with the immigration stuff and the outrage and protests, shootings in Quebec City. It's starting to get a little more risky out there, and you can feel it. It's sort of like driving in your car, and it gets dark. The clouds come over. You roll down the window, and you feel the moisture in the air. You know it's coming. That's how I feel in the market in today's session. Trust me, this sell-off, it was accompanied on heavy volume. There was a lot of contracts hitting bids here that were getting rid of it. Now they're going to let it get primed up a little bit, and they're going to step in and start hitting the bids again and try to take out the slow this afternoon. You've been warned. Can it go up here and start taking out some buy stops and hit the open? It sure can, but it's getting harder and harder. And how many times is he going to do that before eventually we get enough buyers on board to just let them have it? And I think this is the go. And the reason I think that is, like I said before, I think this is the time that we step in here and just take out some stealth stops because shorts got out. If you were in the webinar Sunday at 8 p.m., you'd see why we backed it up with that data. Institutional traders were net long to a very large extent. Shorts started covering their shorts and even buying the market. When you have a short seller, a perpetual short seller, when you got a guy like Soros who starts to get out of his position and take a $1 billion loss on his short positions, when you start to see that stuff, you say, all right, these guys are throwing in the towel. They're getting really frustrated of shorting this thing, and it just rips in their face 2 seconds later. Soros goes in, and other shorts say, you know what, screw shorting this thing. Let's just buy the darn thing. We've missed 7% rally trying to catch a short. All right, well, shorts close out their short. What do? They buy. They pop it through the new high. They attract some new buyers that are late, some retail crowd buyers at this top. Now you got nothing but buyers. How does a buyer exit their position? They have to sell. So when you're already long, you're actually a seller. You're not a buyer, you're a seller. So when everyone's long, you got nothing but sellers. Watch out below. That's a dynamic I can't tell you how few people really understand. Any questions from the trade pros here? Guys, hang tight. Once we end the YouTube broadcast, I'm going to show you some of our positions where we got short oil and where we're going to get short oil some more. All right, we shorted 53.38 last night with an offer, and it worked really well. What else did I write on my notes here of what to watch for? Oh, the big event this week for traders is going to be Wednesday, February 1st. FOMC, the federal funds rate, they're probably not going to hike, and the statement. Traders and algorithms will be reading headlines on any changes of language or any cues as to what the future has to hold in the interest rate path, in their balance sheet, and more importantly, in their outlook for the economy. Tonight, if you want to trade, you got some good opportunities in Japan. The monetary policy statement, their outlook and policy rate is coming up. Japan's been a very interesting case study because they've been doing the same thing the Fed's been doing since the 90s. And they're still saying we can't get rates higher. They're still providing market support. And I think that's what's going to happen to the U.S. They're going to be Japan. Everyone says in the U.S., oh, this experiment that's happening with monetary policy, it's never been done before. BS, it hasn't been done before. It hasn't been done in the U.S., but it's been done in Japan in the 90s. These guys are still holding on for dear life and can't get the rate above 0.5%, no matter what they do and how hard they try. So we're in these low rate environments for a long time. We're not just going to get out of it. We're not going to hike it up. Those traders that are saying we're going to interest rate hike environments and preparing for all kinds of 5-6% interest rates, the reason they're doing that is because they don't understand why they're raising rates. They're raising rates so they can cut them. You guys not get that? They're raising rates so they can cut them. They can't cut 0.5%. What are they going to cut twice, bring it to zero? Then they have to go into negative territory. But if they raise rates by a percentage point in 2017, when 2017 ends up getting a recession, or 2018, and it's coming, I'm saying in the next 16 months, we're going to have a deep recession, 10% drop in the markets. It's inevitable. It's eventually going to happen. That's business cycles. If you've only been trading for less than 7 years, then you may not understand the full power of a business cycle, but that's a business cycle. There's going to be a recession. When there's a recession, the Fed wants to be at 1.5% so they could cut 4 times. There you have it. That's why they're hiking rates. Now you know. All right, Bank of Japan, that's their monetary policy this week, tonight actually. Then on Tuesday, you get their press conference at 1:30 in the morning. So again, that's tonight. When's Britain going? I think they're going on Thursday. Yeah, there you go. UK, 7 a.m. on Thursday, they have their inflation report and monetary policy summary. So there's going to be a lot of moves at central banking week. There's going to be a lot of volatility. Don't get married to your positions. As a trader, the one thing I could tell you is, for goodness sake, get paid. I tell the guys to subscribe all the time. Get paid. I don't care if you want 30 points. The market doesn't care what you want either. Get paid. You got 5 points on the way to 30, take some profit out. If you get 10 points, take some profit out. Here's the dynamic. Traders who don't have a lot of capital say, I'm only going to trade 1 contract on the futures, and I'm going to make 10 points, and that's $500. All right? Understand that on the trip to 10 points, you're going to get 5 first. And whenever it hits 5 and reverses, you're going to make that money. You're profitable. Trader B is profitable here. Trader A makes 5 points and gets stopped out for a loss. All right? So you'd rather trade 2 contracts on 5 points than you would one contract for 10 points. Probabilities are much higher. You'll make money more often. You'll have a higher winning percentage, and you'll have a winning mindset. You won't be going in here getting profit and getting stopped out. All right, or getting stopped out for 5 points, comes down, you raise your stop, I'm going to trail it. You get stopped out. All right, now you're making less money than if you had 2. So don't be afraid to increase size. If you can't increase size on your trading account, that means you're scared. What are you scared of? You don't trust yourself or your strategy. It's always one of 2 things, operator or strategy. It's one of the 2 things you don't trust. Be honest with yourself. Be your own boss. That's the profession you're getting into. Have a great session. Watch the short this market into rallies, short oil into rallies as well. Try to get long gold if you have the opportunity. And those are some trading ideas for you for the remainder of the week. I think we got a nice follow through coming. All right, like they say, the first cut is the deepest. Who said that? I think it was actually a singer that said that. And I think that cut happened today. The market's bleeding and trying to, it's like a deer crossing the highway. It just got hit by a car. It ain't dead yet. It's going to try to waltz off the highway before another one hits it. Let's see what happens. Take care, YouTube. Thanks for tuning in. If you want to try a 14-day trial, sign up at tradeproacademy.com. You'll have the links there. You have 2 full weeks of all of our education, 2 full weeks of live analysis, trade ideas, and our trading floor, risk-free. There's nothing that you need to pay for that trial. There's no paying and canceling. It's literally free. Come out and try it out. There's risk-free. It's the only time anything will be risk-free in the market. Take care. Have a great afternoon. Subscribers, hang tight. Let me show you some trades that we're going to do this afternoon and try to make some more bank off of. Take care, YouTube, and I'll see you at our next midday update.